Well, it was a very strong month for world share markets, with decent gains almost across the board. If we look offshore, the Eurozone share markets were a bit of a standout, with a return of better than 7% for the month. And that's after posing a similar gain in January, so they've had a terrific start to the year. We also had a great month here in Australia, with a return of just under 7%. The biggest contributions to that gain came from the financials, particularly the banks, but we also saw really good gains from the miners. It was a tougher month for bond markets. Australian fixed income managed a positive return, helped along by the Reserve Bank's rate cut in early February. But global fixed income suffered a negative return as government bond yields rose in all the major markets. Well, there are two key things that stand out. One is the actions of the world's central banks. As we discussed last time, the European Central Bank has decided to start its own quantitative easing program, and the Bank of Japan's program is ongoing. But so far this year, we've seen 20 central banks around the world, including the Reserve Bank of Australia, reducing interest rates. The bottom line is that the stance of monetary policy globally, the extraordinarily low level of interest rates, are continuing to provide strong support for share prices. Now, the second issue is Greece. Negotiations between the new Greek government and the European authorities finally reached a deal. Europe essentially agreed to keep the Greek government solvent by extending the terms of the bailout in return for a series of reforms, mostly to do with fighting tax avoidance and public sector corruption. What the deal has done is to prevent an imminent Greek exit from the euro, and to that extent it was greeted positively by financial markets. Greek shares, for example, posted a 20% return in February. Mind you, they lost 20% in January, and they've still posted a loss of over 44% over the last 12 months. The Reserve Bank decided to reduce the cash rate in early February by 25 basis points to 2.25%. And remember, we already had the lowest cash rate in living memory. On balance, the recovery in the non-mining economy is still in train, but some of the data released in February, particularly on business spending intentions, was surprisingly weak. That's cast some doubt on the ability of business investment in the non-mining economy to take up the slack, given that mining investment is still falling. Now, certainly if the Reserve Bank decides to do more to boost growth, there's nothing in the economic data or in the inflation outlook that would stop them from cutting rates further.